Today's lesson will be Chapter 16, Problem 1B. I'm going to share with you an Excel screen that I have made up for you. First of all, we have some notes that we have to go through. In this chapter, we're going to be discussing the statement of cash flows. You might remember that the statement of cash flows is a financial statement that you probably had discussed a little bit in Chapter 1 from ACC 120. The statement of cash flows is a report that shows the company's cash inflows and outflows for a period of time. And it consists basically of three different types of activities. The first activity is the cash flow from operating activities. In this section of the perhaps you can hear me a little better now. We are working on problem 16-1B. And this statement that we're going to be working with in this chapter is called the cash flow statement. And the cash flow statement is a financial statement where we're going to show the company's cash inflows versus the cash outflows for a period of time. And on this financial statement, we break the cash flows down into three different types of activities. The first activities is the cash flow from operating activities. That's the first section that you're going to prepare on the statement of cash flows. And this is the statement that has to do with cash flows that actually affect the net income of the company. Remember, net incomes are your revenues versus your expenses in a company. So things that would affect net income are going to go under the operating activities section of the statement of cash flows. The second section that you'll prepare is called the cash flows used for investing activities, or it's the investing activities section. And in this particular section, you're going to record all cash transactions that come from things that affect our investments in non-current assets. So things like plant assets, when you buy them or when you sell them, they will be reported under the investing activities section. Section 3 has to do with the financing activities section. And the financing activities sections has to do with the financing of the company, which could come from debt that you borrowed, or either you might, in a corporate form of business, sell shares of stock as equity investments for the financing of the company. In this portion of your notes that I've given you, this is an example of a short format of the statement of cash flows. Notice that the statement of cash flows has the operating activities section, the investing activities section, and the financing activities section. Once you have all of these listed on the statement of cash flows, then you combine all of these activities together to determine an increase or a decrease in the cash for that period of time. Once you've determined whether you have an increase or a decrease in cash for that period of time, you're going to add it back to the beginning cash balance, and that will leave you with the ending cash balance for the period. Again, this is a shortened form of the statement of cash flows. Now, in this chapter, they discuss two methods of calculating the statement of cash flows. One of those is what we call the direct method. The direct method we're not going to discuss in this particular chapter. I want you to concentrate on the indirect method. We're going to be using the indirect method in this particular problem, and this is the method that I want you to use. In this class, we're going to emphasize the indirect method mainly because most companies use the indirect method, and you will learn more about the direct method in your intermediate class. So in this class, we're going to concentrate mainly on the indirect method of reporting cash flows. When you are using the indirect method, it's very important to realize that when you are calculating your operating activities, we're going to be adjusting the net income to what we call the cash basis of accounting. Net income is normally reported under the accrual basis of accounting. You'll remember that we accrue our revenue and our expenses so that we can match the revenues and expenses properly on the income statement under the accrual method. Well, in this statement of cash flows, what we're going to do is we're going to adjust our revenues and our expenses that do not involve the receipt of cash payments for the net income. In other words, we're going to adjust our accrual basis of net income to the cash basis of accounting. And so to do that, we're going to start with our net income, and we're going to add any adjustments to reconcile the net income to the cash flows from operating activities. What that will do is that will give us a net amount that we're going to record for our operating activities. And again, I put a little note in here for you to study. I want you to note that the net income is reported using the accrual basis on the income statement. But when we prepare the cash flow statement, we're going to adjust this accrual net income to the cash basis on the statement of cash flows. And this is only when you're using the indirect method of reporting the statement of cash flows. Now, I want you to make sure that you read your chapter in your textbook. But what I've done is I've come up with a way to report the indirect method statement of cash flows in my own way. So I wanted to show this to you because this is the way that I learned how to do the statement of cash flows. And it's just a little bit different than the way they present it in your textbook, but it all ends up being the same numbers that you will get in the end. So you can use either the way they did it in the textbook, or you can use my way. I'm going to show you my way just because I think it's easier. You may not, but I think it's easier. Okay, the first thing you have to realize is that when you're calculating operating activities using the indirect method, we're going to directly adjust our net income. And sometimes what Cengage will give you is an income statement so you can look to see what the net income is. In this particular problem, they did not. They gave you the amount of net income in the instructions to the problem. So you're going to start with your net income or your income statement. What you're going to do is you're going to add back things to the net income to adjust the net income to the cash basis. The things that you're going to add back are your depreciation expense for the period, any amortization expense for intangible assets, that is, if you have any intangible assets and there's amortization to record, we're going to add these back to the net income. We're going to also decrease our current assets, and that means current assets other than cash, which could possibly consist of temporary investments or short-term investments if you have any. Those would be your trading securities that we talked about in the last chapter. If you have a decrease in accounts receivable for a period of time, then that's going to be added back to your net income. if you have a decrease in inventory accounts or prepaid expenses. Notice temporary investments, accounts receivable, inventory, and prepaid expenses are all types of current assets that are the current assets other than just your cash account. You're going to also add back any increases in current liabilities, such as accounts payable, income tax payable, any type of accrued payables. If there are increases in these current liabilities, you're going to add them back to the net income to adjust it to the cash basis. We're going to also keep up with any losses on the sale of our plan assets or our investments. If we have a loss on the sale of assets, they're also going to add back to the net income under the operating activities section. So I want you to notice something here. Some of you might find this interesting. Do you see how I have highlighted or put in bold the first letters of these lines? If you want to think of this as dad and is ill, then this might help you to learn the types of accounts that will add back to net income. This is just something that helped me to keep things straight. On the second part of the operating activities, you're going to deduct out the opposite things that add to the net income. So we're going to deduct out any amortization expense that we might incur on a bond. We're going to deduct out any increases in current assets. Notice it's exactly opposite of the add section here. We're going to decrease any current liabilities, which is exactly opposite of this add section here. And then the opposite of a loss, obviously, would be a gain. So again, if you like to think of things, this spells out the word aid as the first letters of each one of these. And this, I think, will help you in learning how to calculate the operating activities section of the indirect method of the statement of cash flows. Remember, we're adjusting our net income to bring it to the cash basis. Net income starts out at the accrual basis from your income statement. We just pick up the amount of the net income, and then we would look on our income statement for these accounts. If we have any depreciation expense for that period of time, we're going to add it back. If there's any amortization expense, we're going to add it back to the net income. If there are any decreases in current assets other than cash, such as your temporary investments, your accounts receivable, your inventory, and your prepaid expenses, those are going to be added back to net income. If there are any increases in liabilities, such as accounts payable, income tax payable, accrued payables, these are current liabilities that we're talking about here, we're going to add them back to the net income. Any loss on the sale of assets would also be added back to the net income figure. Then we're going to subtract out, if we have any amortization expense on the bonds, we would subtract out any increase in current assets other than cash. We would subtract out any decreases in current liabilities, and we would subtract out any gain on the sale of investments. What that will leave us with is the net cash flow for investing activities. This is the first section of the statement of cash flow. It would be the cash flows from operating activities section, and it's the first one that would be presented on the statement of cash flow. The second one will be the investing activities. Remember, investing activities have to do with cash received from investing types of activities, which are considered to be any investments in plan assets or non-current assets, any investments in the actual investment section of the balance sheet. We would report these in the investing activity section. So we're going to have to analyze our balance sheet accounts, and we're going to have to analyze our income statement accounts when we're preparing a statement of cash flows. But in the investing activities, it has to do more with your non-current types of assets that you will be purchasing and selling, or your investments that you're purchasing or selling. Those go into this section right here, which we call it the investing activities section. If you are selling any of your investments, you're going to be receiving cash. The cash would be recorded under the investing activities section of the cash flow statement. If you are purchasing any plant assets, long-term assets, non-current types of assets, if we use cash for that purchase, it's going to go under the investing activities section. Remember, your statement of cash flows just has to do with what's happened to your cash. You're trying to decide what you brought in versus what you have paid out in your cash for investing types of activities. Once you know what you've received versus what you paid out, that will leave you with the net cash flow or net cash used for investing activities. Depending on the net cash flow would be an addition if your cash received is more than what you paid out. But if the cash that you received is less than what you paid out, then you will, excuse me, you will determine the net amount of the cash flows as being used for investing activities. So you're just taking the difference between the cash that you brought in versus the cash that you paid out for investing activities. That will leave you with the net amount that will be reported on the statement of cash flows. The next section of your statement of cash flows has to do with your financing activities. Remember, there's 3 sections. We've talked about operating, investing, and now we're looking at financing activities. So under our financing activities, we're going to find things or cash that we have received from financing activities, such as if you issue long-term debt, it will go in the financing activities section. If you issue any bonds, which is considered long-term debt, it will go in the financing section. If you issue any stock, if you sell any stock, it's going to go in the financing activities section. That is, the cash amount that you receive from the sale of that stock will go in the financing activities section. Also in the financing activities section, we're going to subtract out any cash that was paid for financing activities. So if we paid back our long-term debt, we use cash to do that, we would record it as less cash paid for long-term debt. We would also subtract out any cash that we paid for dividends or any cash that we use to bring back or buy back our own type of stock, which we call that treasury stock. The difference between the cash that you receive for financing activities and the cash that you pay out for financing activities will give you the net cash flow or that net cash that is used for financing activities. So the 3 main activities section of the cash flow statement are the operating activities, your investing activities, and your financing activities. Once you know the net amounts of each one of these activities, we're going to combine all of those net amounts together to determine an increase or decrease in cash. That increase or decrease in cash for that period of time will be added to the beginning cash balance that is in your ledger account, or also is on your last year's ending balance sheet amount. Your beginning cash balance would be added to the increase or decrease in cash for that period of time, and that will give you the ending cash balance which should equal the cash balance on the balance sheet. So all of this information that I've just talked to you about are things that you need to be aware of before you actually start working on problem 16.1b. In problem 16.1b in Cengage, they're going to ask you to prepare a statement of cash flows for the indirect method. What they do is they give you a balance sheet to analyze for 2 different years. The amount of the balance sheet is recorded below on this spreadsheet here, and these amounts for 2000 Y9 and 2000 Y8 are given to you. What you're going to have to do is, and they've also given you some additional information for helping you to analyze what happens in the statement of cash flows for this period of time. So basically what I did is I copied from 16.1b in Cengage the balance sheet that they gave us for 2 years. This is a comparative balance sheet here. I copied that into my Excel spreadsheet, and I also copied the additional data that was given in this problem. Under the requirements, the only thing they want you to do is to prepare a statement of cash flows. In order to prepare the statement of cash flows, this is what you have to do. You have to be able to compare the amounts of the balance sheet accounts to determine whether there was an increase or a decrease in the balance sheet accounts from 2000 Y8 to 2002 9. And so I put in parentheses here some additional information as to where I did that for you on this Excel spreadsheet. In column G, row 69, you can see that I've added a column here where we're going to determine the increase or decrease from the year 2008 to 2009 in each one of the balance sheet accounts. That's the first step that you have to do in analyzing the information to get it ready to prepare the statement of cash flows using the indirect method. So we're going to look at cash first. And from year 2008, the cash amount was $47,940. It grew, or it increased to $70,720 by the end of the year. So the difference between these two is how I got the increase in cash of $22,780. You go through each balance sheet account and you analyze it. You see whether it grew or it went down during that period of time. So my accounts receivable grew from $188,190 to $207,230. The amount it grew by was an increase of $19,040. My inventories also grew from 2000 Y8 to 2000 Y9. They increased by $8,670. My investments decreased, so that means we must have sold the investments, but we had a decrease amount of $102,000, the cost of those investments. My land, we didn't have any land in 2000 Y8, so we must have purchased $295,800 of land. That's an increase in land during that period of time. My equipment was $358,020 at the end of 2000 Y8, and it increased, so we must have purchased $80,580 worth of equipment to make the ending balance at 2009. equal $438,600. Your accumulated depreciation, notice they put a minus sign in front of that because it's a contra asset account. You remember it subtracts from your equipment account. It's going to have a credit balance. That's what that minus sign means. It doesn't really mean that it has a negative balance. It just has a credit balance, and that's how they put it in Cengage. So they had a credit balance at the end of 2008 of 84,320. By 2009, that had increased to 99,110. What that tells us is that we had some depreciation expense during this period of time, and we created an adjusting entry for the depreciation expense. Our adjusting entry would have debited depreciation expense, and that would be shown on the income statement. And then there would be a credit to accumulated depreciation, which made this accumulated depreciation amount go up by 14,790. So we did have some depreciation expense, which made the accumulated depreciation increase by the amount of 14,790. We also look at our liabilities to see if they increased or decreased during that period of time. My accounts payable was 194,140 in 2008. By the time we got to 2009, it had increased by 11,560. My accrued expenses payable, which could be things like salary payable or income tax payable or interest payable. All of those are kind of lumped together in a group here on this balance sheet. But the ending balance at 2008 was 26,860. It actually increased to 30,600. So we had an increase in our accrued expenses that are liabilities to us. Our dividends payable is also a liability to us. Our dividends payable increased from 2008 to 2009 by the amount of $5,100. My common stock also went up by $100,000, and the paid-in capital in excess of par value also increased by $150,000. What that's telling you is you sold some more stock at above the par value because you had an increase in paid-in capital. The total amount of the stock and the paid-in capital amount that increased is the total amount of cash that you received from the sale of that stock. Your retained earnings had a ending balance of this, and then it went up to 93,000, which was a change of 39,680, which is a positive amount. So the very first thing you have to do is analyze your balance sheet accounts. Determine whether there was an increase or decrease. This is step number one. Then what I would say to you is you would need to create the entries for the data in the ledger account for 2009. These are the transactions A through F, which begin on line, it says 109, but they actually begin on line 91. Oh, excuse me. I actually did the journal entries on 109, but they're coming from A through F up here. So the first journal entry was that we had some equipment and land that we acquired for cash. I copied that right here, and then I prepared the journal entry for you. You have to recreate these journal entries. The whole purpose of that is we need to know how much cash was affected so that we can prepare our statement of cash flows. Again, we're not there yet, so we're trying to get the information ready so that we can put it into the statement of cash flows. So we had some additional information that affected our ledger accounts. The first transaction, we had equipment and land that we bought for cash. So my equipment, what I would need to do is look at my balance sheet that was given to us. Look for your equipment here. Do you see this was the ending balance in 2008, and the equipment grew to this balance in 2009. We actually, what that means is we bought equipment for $80,580. So this amount right here, this increase or decrease, is what I'm recording as a debit to the equipment. Because equipment is an asset, we're going to debit it for the amount that we bought. We bought $80,580. We could tell that by analyzing the balance sheet. We also bought some land. If you look at your balance sheet on your land account, or your land, we didn't have any in 2008. So we purchased all of this land. The amount that we purchased was $295,800. So my land would have been debited for $295,800. Because we bought these equipment and the land, we paid cash for it. It says we acquired it for cash. Our cash has decreased by $376,380. This is the part that we're going to need to prepare our statement of cash flow. But before we can do that, we got to analyze all these transactions. Notice in the B part, they're telling you that there were no disposals of equipment during the year. Since we haven't discarded any of our equipment, there's no journal entry that would be required to determine whether cash was affected or not in that transaction. So there's no journal entry for Part B. But in Part C, we had some investments that were sold for cash at $91,800. So we need to recreate the journal entry for that. We're going to need to look at our investments to see what they cost us. If we sold the investments, we're going to credit them for what they cost us. So my investments account, according to our balance sheet, we originally had in the investments $102,000. By the end of the next year, we didn't have any in there, so we sold $102,000. So $102,000 would be credited to the investment account. Notice they told you that they sold the investments for $91,800 in cash. So our cash would be debited for the amount that was given, the amount that we sold these investments for. Notice the amount we sold it for was less than what it cost us. So the difference is going to be a loss on the sale of the investments. So that's how you would recreate the journal entry for the investments that were sold. Also in Part D, it says the common stock was issued for cash. So in Part D, the common stock was issued for cash. We got to determine how much cash we received from that common stock that we issued. We sold the common stock, in other words. The common stock credit account, or the common stock account, would be credited for the par value of that stock. If you look at your balance sheet, the common stock, the difference between the par values is $100,000. So we are going to decrease our common stock that we sold by $100,000. Our paid-in capital also was from the result of the sale of the stock. Paid-in capital just means we paid more than the par value of the stock. The amount that we paid over the stock was $150,000. So that was credited to the paid-in capital in excess of the issue price over par on the common stock. The two of these together is the cash amount that you would have spent, cash amount that you would have received from the sale of that stock. So always credit your stock account when you sell it for the par value. The difference between what you sold it for and the par value is the addition to the paid-in capital. So we actually sold the stock for more than the paid-in capital because we have a credit which adds to the paid-in capital account. There's an addition to the paid-in capital account. In transaction E, in our additional information, it says that there was a $141,680 credit to the retained earnings for net income. What you have to know here is that net income is going to add to the retained earnings balance. We would have to prepare a closing entry, and unfortunately, they didn't give us all the information that we needed. To close out our revenue accounts, we would need to look at the income statement and debit the amount of the total revenue. To close out our expenses, we would look at our income statement and credit the total amount of our expenses. We didn't know either one of these figures, so I really couldn't put an amount in there for you. But what we do know is that there was net income. And the net income is going to add to our retained earnings balance. So over here on the right-hand side, I've listed a T account that represents the ledger account for retained earnings. This beginning of balance came from 2008. That was given on your balance sheet information. What you're going to do is you're going to add the net income to that, because net income will add to retained earnings. If there had been a net loss, we would have deducted the net loss from the retained earnings, because net losses will decrease the amount of retained earnings. So what you needed to know here is that your retained earnings was increased for $141,680. They also have told us that there was a debit to the retained earnings for the cash dividends that were declared. There's a difference between declaring dividends and paying dividends. In this problem, when you are declaring dividends, you're creating a liability saying that you're going to pay those dividends, or you're going to pay the dividends in the future to the stockholders who are of record when this dividend was actually declared. They didn't tell us the date that they declared the dividends, but they did tell us the amount to debit to the retained earnings for the dividends declared. When we debit retained earnings, we are reducing the retained earnings balance. Debits will decrease retained earnings. Our dividends payable would be increased by the amount of $102,000. I've also kept a ledger account of the dividends payable so you can see what has happened to it during this period of time. There was a beginning balance here, then we're adding the dividends that we declared to that balance. Now, they tried to trick you here, and they didn't tell you the exact amount of cash dividends that you paid. You have to determine that in this particular problem. And to do that, you need to know what the beginning balance is in dividends payable. You need to know that the $102,000 was declared this year. And then from our balance sheet, they gave us an ending balance in the dividends payable at the end of the year. So if you add these two together, it doesn't equal this ending balance. So add these two together, subtract the ending balance, and that will tell you how much dividends that you paid during this period of time. We would have to reduce the dividends payable account and reduce our cash by the amount of the dividends paid. Our dividends payable will be reduced on the debit side because you're reducing the liability account. And then when you add these two together and deduct this, it will leave you with the ending balance that they've given you on the balance sheet for dividends payable. This ending balance is right here at 2000 Y9. So that's all the additional information that they gave you that you needed to analyze to see how cash was affected. So in step 2, we just recreated all the journal entries. We're going to look to see how our cash was affected and how we will report that on the statement of cash flows. So in step number 3, what you need to do is determine which journal entries affect the statement of cash flows, and you're going to put it in the proper activity section. So what we're doing is we're just going back through the journal entries we've created here, where we have a credit to cash. We need to see where that came from. That came from buying equipment and land. That is an investing type of activities and would go in the investing activities section on the statement of cash flows. So journal entry A affects the investing activities as a decrease in investing activities because you paid out cash for purchasing those investments. In transaction B, there were no disposals of equipment during the year. There was no journal entry required, so transaction B didn't affect the statement of cash flows at all. In transaction C, 2 things affected the statement of cash flows. It's obvious that the cash was debited for the amount that we sold the investments for. So in our investment section, vesting activity section, we're going to show this as cash received from the sale of the investments. On our income statement, we would have recorded a loss on the sale of investments. This loss would have affected the net income, and the net income is adjusted on the activities section of the statement of cash flows. So in part C, journal entry C affects the financing activity section, but it also affects, because there was a loss on the sale of investments, the first section. You see there's a loss on the sale of the assets, which is called the operating activity section. So it affects not only the investing activity section, but it also affects the operating activity section. So it affects both sections. So I'm going to update this. I left it off. Because we sold stock, And we didn't sell stock there, did we? We sold investments. And so that's going to go in the investing activities section. So I need to change this to say investing activities section. Okay, let's see here. Let me get this changed properly. Flipping back and forth all over the place. It affects the operating activities section. And the investing activities section. And the operating activities section would be affected by the loss on the sale of investments. And the investing activities section would be affected by the cash that we receive from the sale of the investments. And we'll show you that in just a minute when we put together the statement of cash flows. So A, B, and C journal entries have been accounted for. Now we're going to start with D, E, and F. And D is issuing stock for cash, which is a financing activity. In E, our retained earnings would have been increased because of the net income. And in F, we had dividends that we would need to record for the financing activities section. So in the next part, what I've actually done is I've done what you were supposed to do to start with. You were supposed to prepare a statement of cash flows for the year ended December 31st, 2009. So I'm going to start always with my cash flow from my operating activities. I'm going to start in the indirect method with my amount of net income. This net income would come from your income statement. Then I'm going to adjust the net income to the cash flow from operating activities. I'm going to reconcile the net income to the net cash flow from operating activities. I'm going to adjust my accrued amount of my income from my income statement to the cash basis of accounting. To do that, I've got to add back in any depreciation expense. And the amount of depreciation expense is determined from the balance sheet, because that's all they gave you, in the accumulated depreciation section. Find the difference between the first year and the second year, and the amount of the accumulated depreciation amounted to $14,790. And that is the depreciation expense for that period of time. There would have been an adjusting entry that would have been made and reflected in the accounts, where you would have debited depreciation expense and credited accumulated depreciation. So my depreciation expense is increasing on the income statement, In order to get it adjusted to the cash basis of accounting, we have to deduct that, because depreciation expense, there's no cash outlay for depreciation expense. That's why we do it. In this problem, there were no intangible assets. If you look at your balance sheet, you don't see any intangible assets here. So because there were no intangible assets, there was no amortization on those intangible assets. We're going to look at our balance sheet to see if there were any decreases in current assets. So when we compared the balance sheet amounts for our current assets, all of those with the exception of cash, you can see here that our current assets, accounts receivable, increased, and my inventories increased. They did not decrease. So there were no decreases in current assets. So I put a 0 there to reflect that. The next thing I'm going to look at is whether or not there were any increases in my current liabilities. Current liabilities such as accounts payable, income tax payable, any accruals. In this problem, we had an increase in accounts payable and we had an increase in accrued expenses payable. So the two of those combined are increases in our current liabilities. And that would go under this section of the operating activities section of the statement of cash flows. We're also going to look to see if there were any losses on the sale of assets. In this particular problem, there was a loss on the sale of investments at $10,200, and so that is recorded here. Then what I did is I added all of these amounts together, and once you combine all of these amounts together, the total amount is $40,290, and these are going to be the total additions to net income. So again, I need to change this out here. These are total additions to net income. And so I combined all of these together. I've added all of them together. See how I've got add here? We're adding all of these together. This is my total amount of additions to net income. Then what I'm going to do is I'm going to deduct out any amortization of bonds. And in our problem here, we had no bonds that we were working with. So there's nothing that we could have put in for that amortization. And I've got this part right here, which really needs to be placed up above here. There we go. Because this is the total of C150, your net income, plus C150. I've got that in the wrong place again. Okay. Okay. There were no amortization of bonds because there are no bonds payable. look at your increase in current assets other than cash, accounts receivable, inventory, and prepaid expenses. Your accounts receivable increased by $19,040. Your inventories also increased by 18 or 8,670. The two of these added together is the amount of 27,710. This is going to be deducted from our operating activities when we're adjusting the net income. I'm going to look to see if there were any decreases in current liabilities. Our current liabilities were just increases. So there are no decreases there. That's why there's a zero there. And there were no gains on sale of assets. You would have to look at your income statement for that information. So the total deductions to net income is 27,710. I just added this column up and got this. The net cash flow from or used for investing activities is going to be $284,580. And so the investing activities this should be not investing activities, but operating activities. Got a few things here that I need to correct. Okay, again, net income plus the additions less the total deductions is this amount. Shouldn't be here. It should be on down. Okay, let me fix this. Okay, now that's correct. And then we're going to do the investing activities section. Our cash received from investing activities comes from the selling of fixed assets or non-current investments or any intangible assets if we have any. What we did is we sold some of our non-current investments. And I know that we sold some of our investments from transaction C. The amount that we sold was $91,800. So that's where I'm getting the amount of $91,800. We also bought some land and some equipment. And the total of the land and the equipment that we bought was 376,380. And that's where you get that amount there. Because we're subtracting the cash that we used to purchase the assets from the amount that we received from the sale of the asset, we end up with a negative investing activities net amount. So this would read the net cash used for investing activities is a negative 284,580 because we bought more assets than we sold. There's a negative amount here. And then we would do our financing activities section, which we're going to take the cash that we received from financing activities. So if we borrowed any money for long-term purposes, for financing purposes, including issuing notes payable or issuing bonds, we didn't do that in this particular problem because we don't have any of the long-term liabilities recorded on our balance sheet here. But what we did do is we sold our common stock. We sold the common stock or issued the common stock. And in our journal entry, we had recorded the cash amount that we sold it for, which was $250,000. That was your additional paid in capital plus the par value of the stock. Those were the differences we found on the balance sheet. We'll combine both of these together to get the cash amount that we would have received for financing activities. So that $250,000 comes from cell address B123, which is the debit to the cash amount when we issued our shares of stock. The cash that we paid for financing activities, we did not repay any long-term debt, but we did pay out cash dividends. You'll remember we paid cash dividends here at $96,900. And that's where I'm getting this amount here. The next thing that you would need to determine is whether there is a net cash flow from financing activities or a net cash used from financing activities. And the way that you do that is you take the cash that you received from the sale of the stock and you're going to subtract out the cash that you paid for the dividends, and that will leave you with the amount of net cash flow that was from the financing activities. This is a positive amount because we received in more cash than what we paid out in dividends for $153,100. In the last part of the statement of cash flows, we will need to determine an increase or a decrease in cash. And what we're going to do is we're going to combine our operating, our investing, and our financing activities together. That is $154,000 minus $284,580 plus $153,100. We combine our activities section together, and overall we have an increase in cash. We can check this figure here by looking at our balance sheet and seeing that it matches with the increase that we found from 2008 to 2009. So that increase in cash has to match what you came up with on your balance sheet as an increase in cash. We're going to add the beginning cash balance to that. That information comes from the ledger. You could also get that from your balance sheet cash amount for the last year, which was 2008. The amount was $47,940. If you add that to your increase in cash, overall, you're going to get an cash balance at the end of 2009 in the amount of $70,720. So this just reconciles what you already know. And I'm going to leave that in there so that this shows up properly as the correct amount that you would have there. So so let me check my figures again here. I know that this is correct because it matched what we had up above. Then we added this to it, and then that will give you that. Right here, let me check this. Okay. And this figure right here came from this minus this gives you that. So that really shouldn't go in there. You don't need that at all because it's already up here. All right, so I'm going to leave it at this, and I'm going to attach this spreadsheet that has been fixed so you can look at it further. And I hope this has helped you. And then we will look at the next problem the next time that we meet. Thank you.